Good morning, everyone, and welcome to Bloomberg UK, a special focus on the biggest challenges facing the British government, the economy, financial services and markets. I'm Francine Lacqua here in London. Now, the UK's sticky inflation and cost of living crisis has sharpened the focus on property prices. With the Bank of England's rate decision looming today, we take a much closer look at where the housing market may be heading. Now, the latest figures from Nationwide, one of Britain's largest mortgage lenders, show property prices fell in July at their fastest pace since the global financial crisis for the third month in a row. Now, however, things seem to be improving in terms of mortgage approvals, which increased in June, albeit still below normal levels. Now, key to this are the 13 rate hikes from the Bank of England. Mortgage rates are now above the levels last seen in November when there was turmoil in the UK debt market. The share prices of UK home builders have had a good month, boosted by Britain's inflation rate dropping to its lowest level in 15 months. Taylor Wimpey says home prices have stayed resilient. Now, Bloomberg Economics has a less positive outlook. It says that the housing market remains overvalued and there's a 16% gap between the price of a house and what the fundamentals can actually justify. So let's discuss all of this with Bloomberg's John Sepik and Raj Shah from Bloomberg Economics. Thank you both for joining us. I'm looking forward to our robust conversation on UK housing. So, Niraj, is the UK housing market going to crash? Dun, dun, dun.
It's not going to crash.
Okay.
Well, we expect it as more of a slow puncture than a crash. And we are expecting house prices to fall by 10% from last year's peak. But that's not a crash. For a crash to really happen, you'd need to see a surge in unemployment. So there's forced sales going on from possessions, credit crunch. All of that we see is highly unlikely at this stage. We see unemployment rising to sort of 5% next year. So that's still historically low. And so essentially adjustment rather than a big crash.
Yeah, and I mean, I said it tongue-in-cheek, but the problem is that the UK is so reliant, John, right, on mortgages. If mortgages go any higher, are we going to have a problem? So maybe not a crash, but a kind of crash-like event.
I like that. I like the way you put that, Francine. Look, I think the thing is, like, mortgages, if mortgage rates do go much higher, then yeah, that would almost certainly become a problem, because you can see that people are already stretching themselves quite far. I do think, it's one thing that's important to point out about the mortgage approvals data is that Q2 is usually the kind of high point for mortgage approvals each year. So this is the kind of strongest data in terms of seasonality. The third quarter is usually much more, kind of calmer. And having a wee look at Taylor Wimpey's results, their reservations per unit have gone down as a result of that. So I think that, we are moving into the part of the year which is traditionally calmer for the housing market. And also the latest nationwide figures don't quite take account of the impact of the most recent sort of tick up and down in mortgage rates. So I think we've still got pressure to come. But overall, I mean, actually, I'd agree with Niraj that it's a kind of slow puncture environment rather than a crash, so far.
So far, but I mean, this is the problem, right? So far, and you're still expecting a 10% fall in house prices from last year's peak, which is not insignificant. So again, what are some of the problems that this could entice? And I guess what prevents a bigger drop is, as you said, unemployment for the moment, is not falling off a cliff. But could there be an event that kind of triggers a bigger house drop?
There could always be, and that's why we always say there's an upside and downside risk. Yeah. But the one big thing is that a lot of people are still on fixed rate mortgages. We've had a historically high number of above 90%, and it's Bank of England don't expect the full impact of their rate hikes to come through. Only 2/3 of it's yet to come through, and that's only going to come through fully until 2026. So that gives a huge amount of time for people to adapt and adjust. So we never say never. There could be an adjustment. But I think one thing to keep in mind is a historical perspective. Yes,
which we have a chart, so hold that thought. Yeah. Let's bring the chart up. And basically, how do things compare with the 1990s recession? And how do they compare to the financial crisis?
So, well, if we can actually go back even further than this. So if you go back the last 100 years, house prices have never fallen by more than 20% in one go. So that's one thing to keep in mind. You've had the 30s, Great Depression, the 1950s, where you saw significant declines, and then, as you said, the 90s and the Great Financial Crisis. I think the most similarities are with the 90s, where you had a huge spike in interest rates, causing house prices to fall. But at that time, you also had a surge in unemployment. Yep. So in some ways, this is actually more similar to the 1950s, where all of a sudden you had, during the war, rates at that time a record low of 2%, all of a sudden doubling overnight in the 50s, causing a housing crash. The one caveat there was there's also a big increase in supply, where people started building lots of homes. There's a lot of homes coming on the market as well. So that was one caveat there.
Yeah, and I guess also, if you look back in the 1950s, they didn't have to contend with like a fallout in treasuries. I mean, I know we're talking about shorter term, but it feels like the world is much more complex, right, than 70 years ago.
Oh, definitely. I mean, there's lots more linkages between markets. I mean, the thing is, look, I do think it kind of comes back to this thing of the wider economy. It's if we get a recession, which is I mean, that's the thing that hasn't happened. I mean, if you think back to this time last year, everyone was thoroughly expecting that the kind of country was going to essentially fall off the edge of the cliff.
Implode, yeah.
Yeah, and it didn't. It's done very far from it. As long as we get this kind of adjustment whereby inflation is just high enough but not too high, and employment stays okay, then we can probably get by nicely, because you'll get real house prices will come down, so affordability will improve, because affordability is a massive problem. But at the same time, you won't get negative equity, and you won't get, the banks kind of panicking because all of their assets are underwater. But obviously that sort of depends. It's a bit of a tightrope walk, because, we don't know what's going to happen coming up. The Bank of England is hopefully going to be able to say that, OK, rates have just about peaked now. Yep. But inflation could rebound next year. The base effects are going to start falling out. Well, actually, in the US, they're going to start falling out probably with the next inflation reading. Over here, we're a bit further behind than that. But, I don't, my personal view is we won't see inflation getting back down to 2%, quite possibly throughout 2024. And then you have to start asking, well, will that increase the odds that the Bank of England makes a even bigger policy mistake than it already has?
But, John, and I have to say, I know you always, I always gush about your Money Distilled newsletter, because you never panic, right? But you're always thoughtful, and it's kind of always with this edge of like, watch out, because this could happen. And you basically wrote that, your last one was an uneasy calm in the UK housing market. You talk about mortgage approvals. Yeah. I mean, how can we be sure that actually mortgage approvals, they've perked up and continue on that trajectory?
Well, you're right, they may not. I mean, I do think that is important. We talk about how the housing market hasn't crashed. Actually, it has sort of crashed, because activity in the housing market has collapsed. Yeah. Approvals are running at 55 just now. The kind of 20-year average is 70. But the point is, again, as I said, this is one of the hottest months. Sorry, last month was one of typically the most busy months for estate agents, and now you're going into the summer lull. So, if we've kind of got a standoff, and again, this comes down to the fact there are no forced sellers. So people don't have to sell their homes, and they're not willing to sell them at the prices that buyers can afford or are willing to pay. Typically, you would sort of expect, eventually that to resolve one way or the other, probably in the favour of the buyers, I would have thought. But it just depends on what the underlying economy is doing.
And Niraj, I guess, the Bank of England set to hike again today. Open call on whether it's 25, 50. I mean, most people say 25, but it could be 50. And how does it impact mortgage rates, also given that banks were taken at number 10 for not passing on savings? So I don't know whether that makes them more likely to be more generous with mortgages.
Well, on interest rates, it's a very close call. I mean, we were expecting a 25 basis point hike today to 5.25%, but it is a close call. If they go by 50 basis points, and I think a lot of lenders are actually holding out to see what happens today before they pass on some lower mortgage rates. So if they do go by 50, that might change things in terms of how expensive mortgage rates are. The one thing on the chart was that, and John, you've highlighted this, that literally, although quoted rates are quite high, 5.5%, and but the actual impact on the average on people is still below 3%. Mm-hmm. That big gap is quite significant. It's never been that high, actually. So that's something that shows that the pressure is still to come.
Yeah, but banks are under pressure, right? Are they under pressure to help mortgage holders?
I mean, yeah, I mean, there's the charter that they've signed, which basically just enshrines stuff they'd already agreed to do. Right. I mean, your average bank doesn't really want to repossess someone's house because, frankly, it's a hassle. But also, they're still paying, quite rightly, for, 2008 in terms of their reputations. So I don't think, unless something drastic happened, I don't see kind of repossessions becoming a big deal. I think they're more under pressure on the savings side at the moment, because that's been the thing that's in the papers. And that means, the risk is their net interest margins get compressed because they're busy trying to hand on interest rates to savers and at the same time trying to be careful with their mortgage customers. And also not writing as much mortgage business. So, I mean, you know, at the end of the day, banks' balance sheets are pretty healthy, so it's not, I don't see it causing a major problem.
All right, thank you both for joining us. John Stepek there and Niraj Shah with a thorough look actually at the mortgage markets and what we could expect from the Bank of England. You can also read more from John in his free daily newsletter. I didn't know it was free. It's free daily newsletter, Money Distilled. Sign up at bloomberg.com/UK. Coming up, we'll be joined by Camilla Dell from Black Brick and Ray Boulger from John Charcoal as we continue our deep dive into the UK's property market. This is Bloomberg. Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Now, we continue our deep dive into what's next for the UK property market. And we're now joined by Camilla Dell, founder and managing partner at Black Brick, and Ray Boulger, senior mortgage technical manager at John Charcoal. So I'm delighted to have you both to have a look, first of all, at some of, I guess, the high-end property market, exactly who's buying what, and also more of the technical side of mortgages and who's managing to get approvals. So Camilla, let's start with you. What are you seeing in terms of trends that maybe are surprising compared to either a year ago or 2 years ago?
Yeah, I think it's interesting because when you look at your previous guests and listen to what's happening in the wider UK market, property-wise, it all sounds really negative, very doom and gloom. And I think it's important to distinguish London from the rest of the UK. It is a very, very different market, driven by very different factors. And when you look at, you know, whether we're seeing prices reduce and coming down in central London, not really is the answer. Prices have come down 0.2% this quarter across London, and over the last year, they're down just by 1%. So I think it's really important when you're listening to sort of the wider picture of what's happening in the UK housing market to remember that London is really driven by quite different factors.
But I mean, is this London in general? Is it, you know, higher end? Higher end? Because I know in your notes you also say that there's a lot of people that want flats, and that's been one of the main drivers.
Yeah.
But they also have a lot of cash. So this is maybe not, you know, a normal UK worker.
Yeah, absolutely. I think when you look at London, you've got to look at the different parts of the market. Clearly, the more debt-driven parts of the market in London are not doing as well as the higher end. In our own data, what we're seeing is a shift towards our clients taking finance to buying purely in cash. So far this year, 57% of our clients have decided not to take finance and to buy in cash. And when you look sort of, you know, when you really drill down and look what's happening in the market, sort of the market above 3 million and above 10 million is faring quite well. Conversely to that, the market between sort of £500,000 and £1 million, as you might expect, is not doing as well, and there has been price decline there.
So, Ray, give us a little bit of your insight into what people want in terms of mortgages. I know you say, for example, tracker mortgages currently look better value than 2-year fixes. Does that, how often, you know, or when did that change?
Well, you say better value, it's cheaper, but that doesn't mean it's better value. I think at the moment, because there's about a 0.5% gap between the cost of 2-year fixes and 5-year fixes, but you can actually get a tracker mortgage that's significantly cheaper. And even if bank rate goes up by another 0.5 point, the best tracker mortgages will still be cheaper than the best 2-year fixes. So I think whereas until fairly recently, the choice for mortgage customers has been, should I fix for 2 years or longer? Now, actually, the question is, should I take a tracker or a fixed rate? But I don't think 2-year fixed rates actually have much value. I think if you're going to go for a fixed rate, you may as well go for something longer if you need that security of knowing what your payments are going to be. Plus the fact that because of the way lender stress tests work, in some cases, if people are stretching their budget, they will find they can borrow more if they choose a 5 or 10-year fixed rate than if they choose a tracker. So for some people, that might be a key factor.
So what's your best piece of advice right now for someone who's either new to the property market or needs to look for a bigger place?
Well, one of the questions, of course, is now a good time to buy? And I mean, Camilla will, I suspect, have a similar view to me on this. I think the right time to buy is when actually it suits your personal circumstances. I mean, if, for example, you're a first-time buyer, then if you expect prices to fall over the next year or so, which I do, but I don't expect them to fall dramatically, and you've got to weigh up the benefit of having your own property, having security of tenure, compared with perhaps paying rent for another year or so. And when prices are falling, then it's a buyer's market, of course, and it means you're in a much better place to negotiate a good deal. So the time to buy is actually before prices have bottomed out, not to wait until that happens, and then you're in competition with lots of other people. If you're moving home, then of course it swings and roundabouts. And I think the biggest challenge at the moment for a lot of people is going to be making sure whatever chain they're in, assuming they're in one, actually doesn't break down, because when the market's slow, it clearly becomes much more problematic to replace somebody who drops out of a chain. But basically, if you're buying a property, I think you need to negotiate hard. Bear in mind the market is very different to even 6 months ago, and you are in a buyer's market.
Yeah, and Camilla, how big is the mismatch between, I guess, the prices that owners want to sell at and buyers want to buy at?
Yeah, I think, we see on a case-by-case basis very, very different scenarios, and each negotiation that we handle as a business is specific to that particular deal and that seller's circumstances. Average savings for us as a business are about 4% over the last 12 months. So, yes, it is a buyer's market. I think buyers, particularly in the prime markets, also need to be quite mindful of the fact that not every seller in prime central London needs to sell. And I saw a recent report that suggests only a third of homeowners in London actually have a mortgage. So whatever happens with interest rates today, there's a lot of homeowners in London that, quite frankly, are not being affected by rising cost of debt. So you've got to remember that. I agree with Ray in that I think if you're buying a home at the moment and you're waiting for prices to fall, yes, that's a factor, but I think the most important factor is, can you find the right property? Traditionally in prime central London, there has been a supply-demand imbalance. We are continuing to see that at the moment. And in fact, on some of the transactions we're doing, our clients are having to compete, even now, even in today's market, and pay sometimes over the asking price to get the property that they want.
Camilla, a third of people in London not having a mortgage is a huge number. Is that because they've had the property for a long time?
I think it's a combination of having the property for a long time, but also just paying off their mortgages and the sheer volume of cash buyers that we see in the market as well.
Okay, our conversation, of course, on the UK property continues. Camilla Dell from Black Brick and Ray Boulger from John Charcoal Mortgages. Stay with us. That's coming up shortly. And this is Bloomberg. Welcome back, everyone, as we discuss what's next for the UK property market. Still with us, Camilla Dell, founder and managing partner at Black Brick, and Ray Boulger, he's senior mortgage technical manager at John Charcoal. So, Ray, let me actually go to you first. When you look at mortgages, I know you've given some good advice to negotiate hard, but also move and size up when you have to, which is just in general good life advice. Is there something that you worry about people overstretching, thinking that their jobs are safe? And this, I guess, is a great unknown in the economy, because there's a tight labor market. The economy is fine until it's not.
I don't think most people are going to be worried about their jobs, but if they are, they're not likely to be looking to move house. And of course, people who've got mortgages now will, in the main, have been stress tested for rates of around 7% or so. So in theory, most people should be able to afford even these higher rates. Obviously, other factors will have influenced things in the meantime, so it's not that simple. But I mean, one of the interesting stats, I think, which gives you an idea as to why house prices have to fall further, is that although, as Camilla said, a higher proportion of people are now buying for cash, I think that's probably truer in London than elsewhere in the country. It's always people at the margin that actually affect prices. And if you compare how much somebody could have borrowed when mortgage rates were, say, 1.5% a couple of years ago, and what they will be able to borrow now, or perhaps in the future. Now, I'm thinking mortgage rates will be back down to 4% within a year or so. Even at 4%, your borrowing capacity is about 20% less, given the same mortgage term, as when rates are 1.5%. Because people can afford is such a key factor in what they're prepared to pay for a house. That's why I think we're going to continue to see house prices drift lower for the next year or so.
Yeah. So, Camilla, what are your clients asking right now?
Is it the right time to buy?
Yeah.
What is supply like?
Are they shy in spending too much? Or are they trying to, if not downside, just being a bit more careful?
Yeah, we've seen some price adjustments, some budget adjustments with some of our clients who are borrowing and, you know, just looking at how their costs have risen and having to adjust their budgets accordingly. So we've definitely seen that. I think clients are definitely cautious at the moment. They're not just gung-ho going out there and just spending at a whim. They're definitely much more considered purchases. They're taking their time to really make sure that they're finding the right property and that the price is at a level that is acceptable to them. And you know, so we're seeing that our transactions, the length of time it takes us now to actually bring a client to finding the right home and seeing that through is taking much, much longer at the moment, I would say.
All right, so interesting. Thank you both for joining us. Ray Boulger, Senior Mortgage Technical Manager at John Charcoal, and Camilla Dell here with me in the studio, founder and managing partner at Black Brick.